Oh, I love it when there's a good nerd off going on, and it seems to be a big geek off and stat off between the IMF and the UK government. And if you haven't seen the story that came out yesterday, it looks like the UK government is a little bit annoyed with the IMF about the latest report on the World Economic Outlook that came out in October of this year. So today, what we are going to do is we're going to dive into this report, not really to spend too much time looking at the whole global economic outlook. I'm not sure how, well, it probably is relevant, but there's a lot of data to get through there that is probably not that relevant for a property market. I want to pick out the bits that have been highlighted in the press that kind of pertain to the UK, especially where the UK sits in its peers, and some long-term forecasts of what's going on in the UK, which I think is super interesting. And we're going to tie it into everything we've been talking about for the last couple of months. So first of all, we are live. If you can hear me and see me, please give me a big thumbs up. Please find something in the in the comments. I can see people saying they're getting that tune stuck in their mind for the opening intro. If you're watching on the replay, again, please play Fallout as if we're still on the live. Put your comments in, put your thoughts in as I ask the questions. I'll always come back and answer them. And a big welcome to everybody who subscribed over the last week or so. If you are new to the channel and you haven't subscribed yet, the point of this show or this live stream is to crunch data, to look what's going on, get past the headlines, both in the mainstream media and in the social sphere as well, to see what's really going on beneath those headlines, understand the data, to enable us all to make better decisions as investors or people who are buying assets or even building businesses. So that's what we are going to focus on today. So welcome to everybody. Okay, without further ado, let's dive into it. So I don't know if anybody's had a look at this. The World Economic Outlook by the IMF recently come out. Now, I'm not going to, as I said, I'm not going to go into all of it. I'm going to give you a quick précis, and the little subhead there of navigating global divergences pretty much gives you a précis of the entire report, which is the world is a little bit more resilient than everybody thought maybe beginning of the year or last year. However, it's pretty downbeat, and we are sort of dropping off in terms of growth globally, but specifically, and this is where the divergence is coming from, advanced markets. So, for example, America, USA, Europe, Eurozone, UK are doing worse than emerging markets. And since by the way, this report comes out every 6 months. Since the last report came out, the Eurozone has been downgraded, and the country that's been downgraded the most in the Eurozone, although we're not in the Eurozone anymore, let's just say Europe, is the UK. So this is why the UK government is particularly unhappy, especially as they run up to election, because they've been putting out all of the hyperbole about how amazing everything actually is and how the economy is doing much better than we thought it was, and the IMF's kind of disagreeing. So I want to dive into the data and have a look at that. Now, I've been through this this morning, and I've picked out some key things I want to talk about that go for the UK. Now, the first of these is inflation. And interestingly, you would think or hope that a report like this, okay, which is not done by Bank of England or done by the ONS or done by the UK government, might have some more impartiality in the data. So there's a lot of comparisons going between various countries, various economies within the world. World's a big place. And this is one of the first things I wanted to pick out, which was inflation and how we are faring compared to US, Euro area, and then nicely, I don't know why they actually singled the UK out. We're singled out quite a lot in this report, the UK. Now, what is very obvious, if you look on this graph, and I'm just going to put my pen on quickly. Let's go green down here. If we look at sort of this side of it, okay, so left-hand side, this is graphs of total inflation, which is red, and blue is the core inflation. So if you remember, if you've been watching this show for a while, we talk a lot about headline inflation been coming down. That core inflation is what we really care about. It's been sticky, but in the last month or so, it has come down a decent amount. Now, if we look at the states, right, the red is headline. The red is everything. Blue is then core. You can see how the red has dipped off very quickly. Now, the red is that headline inflation shock. So when you look at cost of utilities, for example, cost of food, that is all in that, the more volatile costs. So in the US, that has dropped off much more quickly. And really, they're now, their main inflation is the core inflation, but that has also come down quite quick. So we're all the way down here, what's that, sort of coming up to 2%. And we're actually sort of deflationary down here with those headline inflation shocks. Interesting. Euro. Oh, sorry, I didn't mean to write that there. Euro. Oh, I've done it again. Sorry. Let me just use two fingers. Euro area is actually the same. You can see the red has dropped off, right? Red is now deflationary and the core is coming down. Whereas if we go to the UK, we are definitely a little bit of an outlier in this. And that we've been suffering this sort of headline inflationary shock for a lot more. So those cost of utilities, cost of food has really impacted us a lot more as a country to the States and to the Eurozone. We can also see, okay, how little this blue bit is coming down. We have seen, I'll just draw on over it. If I zoom in there, you can see we've had a little tick down there. But when you compare it to the rest of them, and I'm just going to take these green lines off so you can see if you go to the Euro area, look how much that has come down. Same with the States here. You see how much it's come down as well. We are lagging behind. Okay, the UK, without a doubt, is lagging behind in terms of its core inflation. And the reason I'm focusing on this core inflation stat is really it's the thing we need to be looking at to see how we are doing internally as a country. So when you strip out all those volatile things, because that for me is the thing that's going to be one of the main drivers for interest rates. And we're going to talk quite a lot about interest rates on this, because there's some interesting analysis of where our interest rates are going to be going compared to everybody else's. So that's the first interesting snapshot. Now, second interesting snapshot, I feel, is almost looking into the future here. Without a doubt, the States has been ahead of us in the whole curve, both with going up and coming down again. Over last couple of months, I've been talking quite a lot about we are in a race. I'm just going to come off this quickly and I'll go back to it. I've been talking about how we are effectively in the UK in a race between interest rates coming down again to make things more affordable versus the amount of liquidity in the system. And right now, one of the things that is propping up the housing market without a doubt is the fact there still is a lot of liquidity after all that quantitative easing. A lot of money made its way into people's bank accounts, savings accounts, and therefore, even with the cost of living crisis, affordability squeeze, because there's liquidity in the system, that's cushioned it somewhat. But we're in a race with cost of living staying high, inflation still very high, okay, and interest rates, that gap between the sort of rate people are on and the amount of people on it getting bigger all the time, that is putting a lot of pressure. And we talked about the net savings outflow that we're now starting to see in UK bank accounts as people are effectively covering that cost of living. Now, when we look at this chart, it's showing very clearly that in the States, they've been seeing that. Now, by the way, this only goes through to Q1 23. So I would say pretty out of date in terms of data. But we can see this blue line here is the States, right, where they're in a negative. So rather than this is a graph of cumulative excess savings. So when we go negative, we're effectively depleting savings. There's no excess savings. We're depleting savings. You can see in the States quite aggressively that has happened, right? So in the States, people's savings are outflowing. You can see the curve for what is effectively, Eurozone and UK. And the UK is the red line here. So actually the lowest of all of them. Now this data takes us to, if we look at it, pretty much the end of 2022. So we've got almost a year extra on this. I'd imagine we're going to be very much following the curve here of what the States have done and seeing that drop into negative when we look at this in 6 months or 12 months time. Now again, that is also relevant because it clarifies that narrative that we're effectively seeing money run out, and at some point, right, UK residents will be running out of money in terms of an excess savings. And that's when, if we get to that point, and I'm not saying we are going to get to that point, that's when things could get more ugly for the housing market, because if people are in negative equity and mortgages are a lot higher and we can't afford it anymore, that's when people are forced to move. And right now, people are not necessarily forced to move because there's liquidity, so they don't have to. So this is why we're seeing the whole market effectively paralyzed at the moment. Okay, let's look at monetary policy. So this is a graph. Right, there's lots of data and explanation in the report. I've linked to the report, by the way, in the description. So if you want to go and read the entire World Economic Outlook, please feel free to do so. It's not the most interesting thing. All of these graphs are kind of broken down in a bit more detail as to where their sources are and what they actually mean. This effectively is a forecast of real-term interest rates going forward. So we are expecting, and again, United Kingdom is being singled out again. So States is in the red, Euro area in the yellow, and we are the blue. So effectively over here, the top line, although we're kind of 2027 going the same as the Euro area. But we're expecting those interest rates to stay high. Now, real term interest rates are obviously the headline interest rate adjusted for inflation. So we've been seeing the interest rates, sort of ramp up. They are going to start coming down as inflation changes, but we are very much as a country sitting there above everybody else. So that's interesting that the UK monetary policy is forecasted to remain tight. And this is the graph, okay, this is the graph that got UK government PLC their knickers in a twist. And actually, I think have caused a little bit of concern for a lot of people reading this. So again, this is a forecast. And by the way, right, this is going through to 2028. This is where we are here, right? We are here. Now, this report came out this month, right? So literally this week, last week. It's a very recent report. United Kingdom in the green. The IMF is predicting a peak of interest rates at 6%, right? And then let's just follow this through. We're starting to come down. Now, I've said, and feel free to go back through other videos, I've said I feel it's unlikely we're going to come down in interest rates until probably summer 2024, so mid-2024, which would be kind of pretty much what this is saying. But then I said it'll be a gradual decline, so don't expect it to fall off a cliff. Now, what they are saying, IMF was predicting that we're going to stay around about the 5%. Sorry, it's kind of, I think that's actually 4 point something here, but that's 2028. We're going to be staying around the 5% mark, probably until 2026, and potentially not far below it until 2028. Now, this is hugely relevant for the UK property market, and I'll run through why in a little bit. You can see, by the way, now, if I just get rid of my green scrawlings, the dotted lines are previous forecasts. So you can see UK down here, right? Previous forecast is a lot lower. So they're expecting UK to be higher and more persistent in terms of interest rates than everybody else. US, you see the divergence here between Euro area is in the red. US are sitting at about, what's that, 2.5%, certainly sub 3% by sort of 2026, 2027, with us sitting a good 2% above that. That's what they're forecasting. Whether or not this is going to happen or not, and they do say, there's tolerance forever. Everything is a forecast. Nothing is perfect. Now, why has everybody? In fact, wait. I'll get back to that in a sec. Because I'm going to say, why has everybody got their knickers in the twist, or UK government got their knickers in the twist? I'll get back to that in a sec and talk about why a lot of people are saying, look, this data is out of date. Is it BS? And why has this gone in? We'll talk about that in a sec. I just want to go on these monetary policy assumptions to back up what this is saying. So if we read down here, from here, the Federal Reserve's policy rate is expected to peak at its current level of about 5.4%. The Bank of England to raise its to peak, poor grammar there, raise its to peak at about 6%, and the European Central Bank to raise its to peak at 3.9% in 2023 before all three reduce rates in 2024. So again, correlates to what I said, we're going to start coming down in 2024. And then, there we go. The higher policy path over the longer term has contributed to the rise in long-term policy rate assumptions, blah, 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 blah. That's what they are saying. I'm just going to scroll through to this. I think I would like to talk about this now as... no, in fact, let's not do that. Let's not do that. We'll come back to what they're talking about because there is a bit more to it, to GDP, as well as just the interest rates. A couple of other things that we've picked out of this is, I thought this was interesting actually, because there's been a lot of chat recently about secondary inflationary effects in the UK. Specifically, when you look at the numbers, we're about to have some, we're about to go through 12 month on 12 month. If you look back 12 months ago, we're pretty much hitting the peak now and next month. So that's about to fall out the data, which means we're probably going to see another drop down to Sunak's target of about 5%. I wouldn't be surprised if we do hit that 5% overall inflation in November, December. But then we're going to see a period where it actually didn't do much in terms of inflation for the next quarter. And if we can, that will probably reduce, potentially even, it's sort of flatlining for a bit, which goes into that narrative of stickiness. And then there's a narrative of Brent crude going up in value. And as that works its way back into the supply chain, is that going to cause secondary inflation that's going to actually cause it to rise again as we go into Q1, Q2 next year and cause interest rates to spike? So that is one hypothesis. Now, if we look at the sort of global Brent crude, we can see here, right, if I look at that bit, is the little uptick we've just had. And again, if we look at this, we've seen this, this uptick for the last however many months. But recently, over the last couple of weeks, it has come down pretty aggressively. So we've not seen a continuation of that uptick. And if we look at the forecast, we are expecting Brent crude to continue down until, well, I mean, the end of this graph is 2028. The fan chart is suggesting that there's a higher probability of, or confidence, probability, confidence in it being lower than higher. Of course, there are so many things that can happen in this time period. We could have, additional supply shocks. We don't know what's going to happen in Ukraine. This could all make it go back up here. But the general, if you take sort of look at the quantum of probabilities and look at the highest possibility in terms of like an inverted bell curve, it is a slight decline over the next 4 years. So it'll be interesting to see how that plays out, because that will have an impact into inflation. So I wanted to highlight that because I've been saying recently that we're probably going to see this go back into the system if it continues up, because we did see a trend from about $75 per barrel up to 95 in not a very long time period in August, September. It's come back down. So let's just see where that goes. We might see, by the way, some of it filter into this month's CPI print. And then, here we go. Right, here's the sort of forecasts for inflation with several economies. Again, we can see UK here, effectively, right, US has dropped off more quickly and then shallows. Euro area again drops off more quickly and then sort of flatlines, whereas the United Kingdom is lagging a little bit when you look at that. So it's taking longer for the UK to come down. I'm not particularly interested to compare us to Brazil, Japan. What is interesting is China has been having some serious economic headwinds, right? Big housing crisis in China, and that could have ripple effects that comes into the Western world as well. Talking about house prices, here's a snapshot of global house prices. In terms of the blue is the change in house prices between 2021 Q4 and 2022 Q3. We can see we are sitting here so we're actually the second, right? That's us here. We had the second highest rise in house price in terms of percentage in that post-COVID pandemic, kind of only behind Russia, which saw significant increase there. And actually, we're not faring too badly in terms of the decline, because you can see over here we've got some big declines in Australia, in Canada. I'm kind of focusing on Western economies now, but that is where we are now. Don't forget, a lot of this stuff is probably further ahead of us in the drag curve. The only other thing to talk about is effectively where they're seeing us in terms of GDP. And this is the second place. So interest rates got the government all upset. The second place the government got all upset is the assessment of GDP forecast for the UK. Now, if you remember, if you've been following any of my other lives, we talk about Blue Book 2023, which was a revised methodology for calculating GDP, which came out recently. And that revised methodology, amazingly, pre-COVID, no difference in terms of the two lines. After COVID, after Blue Book 2023 methodology is introduced, we're doing way better, right? So this is where the government and Hunt and Sunak are like, look, this economy is doing better than we thought. Even with these headwinds, right, we are growing. Let's see what IMF reckons. So if we go UK down here, they're forecasting for 2023, well, 2022 last year, they're forecasting, it happened, 4.1% growth. This year, they're projecting 0.5% growth, and next year, 0.6% growth. Now, if we compare that to some other places, we can see that on average, advanced economies are 1.5 this year, 1.4 next year. So we're significantly below both of those. US is 2.1 this year, 1.5 next year. Germany is struggling this year, minus 0.5, but forecast more for next year. And then if we look at the difference from the last update here, we can see they've actually revised 2023 up very slightly, 0.1. And actually, I believe that their update or their forecast for 2023 is slightly more than ONS, our own ONS, is forecasting. But next year, look at that. We are the laggards next year with minus 0.4%. Okay, so that to me, minus 4.4%, if that pans out, we'll see recession into 2024, which again, backs up a lot of the narrative that when we talk about this and we look at the month by month, quarter by quarter, and looking at that feeding in the interest rates, because we've tightened that much more, and it looks like it's going to have to stay persistently higher for longer. Next year is when it's really going to bite. So we talk about housing market. I've said this winter into next spring is probably going to be max pain for our housing market. Same for the economy. This winter into next year is probably going to be max pain for the economy. And with the interest rates staying persistently higher for longer, that will probably lead to a more drawn out correction in property prices if that's the case. Okay, so interesting forecast there. Now, this is where, by the way, as we're going through this, and I'll just, before we go and look at the sort of spat between what's happened between the IMF and UK government, if you've got any questions on that, or thoughts of that, please put them in right now. Put them in the comments, and I'll go through them after we finish going through the data. I'd love to know your thoughts on that and where you see that going into the, we're in Q4 2023 now. As we go into 2024, how do you see that panning out? I'll be interested to hear your thoughts on that. And finally, this is where I'd ask everybody a favor. Okay, I always ask it, and that is that that my vision here is to grow a community and grow a channel, right, that cuts through the BS, is not full of hyperbole, right, is not full of unrealistic expectations, and is here to help other people make effective decisions. And to do that, I need your help to grow the channel, to reach more people. And the best way of doing it is for you to subscribe to the channel and to like and share these videos. And it amazes me when I look at the stats, how with the tens of thousands of views we have every month now, only 0.01% of those views turns into a subscriber. So I'd love to ask for your help. And one favor, it's the only favor I'll ever ask you, is to subscribe to the channel and like the video. And in return, I'll carry on doing these videos and putting more and more resources into it. I've been interviewing all day for an executive assistant to start help growing the team to actually grow this channel and grow what we're putting out there, because I think it's really useful, and I hope you'd agree with that. So it's the only favor I'll ever ask. And in return, I'll continue to work and get all this data out for you. There we go. Please do that. So how is this now manifesting? A lot of headlines yesterday with IMF having to defend the gloomy UK forecast after government criticism. So the government's actually actively come out and criticised this. So you see at the bottom it says, the group has denied being pessimistic. Interesting. So what the Treasury has said, okay, and this is the line here, and I know this is taken from BBC mainstream media article, and we always have to take sources and where this stuff comes from with a pinch of salt when you're looking anywhere, to be honest. There's so much fake news around. But if this is true, right, and the Treasury said that the recent revisions to UK growth, and by those recent revisions, they mean the Blue Book 2023, which has suddenly found, 0.8% extra GDP growth this year, something like that. They're saying that the IMF has not used this data. Before we talk about that, it's really important to clarify that this Blue Book 2023, on the opening page of it, says we can't really use this to assess us in relation to everybody else until everybody else in Europe changes to the same methodology. So we are now using a different methodology to what everybody else is using, and following it through, it sounds like everybody else is going to be revising to this methodology as well. So it says on page 1, right, we can't really assess this until everybody else is using it. So that's the first thing to say. Now, Treasury says this growth has not been factored in to the IMF's report. And the other thing it's saying, that the data was taken as a snapshot. The data of this report was taken in August. If you remember, in August, we were coming off that spike in swap rates, the interest rate swap rates, after that sticky inflation for a couple of months where it didn't come down. And that's when we saw mortgages start to spike again. But since then, since we've had the better than expected inflation, by the way, better than expected does not mean good. We are still just under 7% inflation, right? What's that, 18 months on? We've obviously seen swap rates come down, mortgage rates coming down. There's a huge amount of competition in the mortgage market at the moment, especially for existing customers, because nobody's buying, nobody's selling. The whole thing's paralyzed. So lenders need to try and get business. So I saw a headline rate yesterday of 3.5%. I think it's by Skipton, something like that, but a 5% arrangement fee. So you're getting these headline rates which are low, but then these ridiculous arrangement fees which actually take it up to way more. Not 5%, £5,000, £5,000, £5,000. Was that 5% of 5? I can't remember. Anyway, it made it ridiculous. So they're also saying that the recent drop in swap rates and the softening of that forecast of where we're going to peak hasn't been included in this data. Interestingly, okay, the IMF came back straight away and rejected it, and they said that they've, I love this, when you put some exclamation marks on, it's very authoritative, isn't it? Absolutely factored in the interest rates peaking late last month, and that there is no discrepancy. He added that a preliminary read of the ONS's revised data had changed the picture for 2021, but probably not much for the current forecasts. If anything, he said, past upgrades for 21 would mean there is less room to grow and catch up. So it may not lead to a big change upwards in terms of the growth performance. So UK government said, look, your data's rubbish. We revised everything. Figures are much better. IMF has said, no, we've totally categorically incorporated all of that into our report. So I don't know who's right. At the end of the day, we're on YouTube talking about it, but it's just interesting to see that sort of stat off, geek off, data set off, and how even experts at a global level cannot agree on exactly what they're seeing. So how can anybody else really know exactly, forecast exactly what's going to happen? The answer is we cannot. And if anybody says they can, they are lying to you. Probably going for clicks. And we have to look at trends. As I always say, the key here is to look at trends of what's going on. And the narrative, everywhere we look, Halifax HPI, nationwide HPI, this document, anything coming from the Bank of England now is saying that in the UK, interest rates are likely to stay higher for longer. What else have they said? Here we go. Jeremy Hunt. The IMF has upgraded growth for this year and downgraded for next, but longer term, they say our growth will be higher than France, Germany, or Italy. Trying to clutch at straws there, Jeremy. To get there, we need to deal with inflation and do more to unlock growth. Yes. Now, on Tuesday, the Bank of England's Financial Policy Committee, which monitors the stability of the UK financial system, also warned of UK's high interest rates. Now, I mentioned this last week in my live. This was taken from that report. These slides from last week's live on the UK Financial Stability Report, which was effectively, and it basically breaks down stability into three sections. One is banks, second is business and homeowners, and third is effectively non-bank institutions like pension funds, things like that. Focusing on business and homeowners, which I think is the most relevant for us, they are talking about the amount that mortgages are set to increase over the next 3 years, not just the next 3 months. They're talking about the next 3 years. So by the end of this year, this is the amount of extra money that people are going to be paying on their mortgages. So 2 million paying up to £200 a month more. What's that? 300,000, £500 a month more. By the end of 2026 Q4, you're talking about 1 million people, 1 million households paying £500 a month more on their mortgages. That is not an insignificant amount of extra money to find for 1 million people in the next few years. And then they talk about the proportion of all income in the UK, or the UK collectively spends on mortgage payments. And you can see again this. In fact, what I did is I put a second slide on here so we could look at the time period. You can see the trend again. The trend is definitely, and by the way, that if you shallow this off or continue that curve, we're likely going to be peaking around 28. So it looks like this mortgage shock, this additional mortgage burden, is going to be going on for 4, 5, 6 years from now. Okay, and while that is happening, clearly, depending on what happens with inflation, depending on what happens with nominal wage growth, we don't know because we're talking quite a long way out here. It doesn't really matter. Is if the interest rates are higher for longer and more persistent, this is going to cause a real-time impact on house prices. I cite this every time we talk about interest rates. Okay, I cite the Resolution Foundation paper called Peak Interest and this staff working paper from the Bank of England, which suggest, and again, it suggests this is a theory, but it's a very well theoretically, mathematically worked through theory, suggesting that a 1% change in real interest rates that is persistent could move real house prices by just under 20% across many years. Okay, across many years. So if this follows, and this is true, then we are looking for a long haul reduction in real term interest rates. Now that doesn't necessarily, interest rates, real term reduction in house prices. This doesn't necessarily mean nominal house prices will continue to fall. I would imagine if we continue with wage growth, anything like it is, then we could see a long-term shallow decline in real house prices. Now, this is important because as investors, real house prices are the actual, store of value in that property that you own. So even if we have stagnating or slightly rising house prices in 4, 5, 6 years' time, those real house prices could still be coming down. I talked last time about in the late 70s, late 80s, and the 2008 house crash. It took pretty much every time 7 years peak to trough in terms of real house prices. So if they started coming down last year, 2022, we might expect real house prices to bottom out 2029, which actually correlates with those interest rates starting to come down more significantly. So 28 to 29, we could see real house prices in decline too. When we look at affordability, again, this is from the peaked interest. It talks about the new normal scenario, which is persistently high interest rates. And actually, this model's 3.5% base rate, with house price to earnings ratio settling down here about 5.9%. And I just grabbed this off nationwide affordability data just before we came on. It's a graph that shows all of these are all of the regions in the UK, including UK total, in terms of house price to earnings ratio. What we can see very obviously, if we draw a line there, is we have a very clear drop off now of house price to earnings ratio. So we are seeing that correction. And even though we're not seeing, massive amounts of falls in terms of nominal house price, and everyone's like, where's the crash? There's no crash. There is in terms of the real value of properties, right? And I keep maintaining that. That is where the crash is happening, the real time value of properties. But because we're in this high inflationary environment, it's being masked in terms of a nominal. So there we go. That's an interesting report to go through, and hopefully that shows a fair bit of sort of I'd like to think more impartial data from people, from analysts, economists outside of the UK putting something together. It 100% backs up everything we've been talking about higher and persistent interest rates for longer than people are perhaps considering. So just a snapshot that I am still calling probably decline in real time house prices for at least another 4 or 5 years. I don't expect that to happen in nominal, because if nominal wage growth continues, then that will probably, I would imagine, will probably trough next year in nominal terms and then stagnate for a while. The only thing that will change that, okay, is if something puts us over a tipping point in terms of a full-on deep recession and unemployment spikes, which is not forecast from any angle now. And there was some interesting narrative about the concerns over the banking sector that we saw in the spring of this year with Silicon Valley and Credit Suisse. Those concerns have largely gone. Metro Bank's definitely an outlier. Even though we might go into, I guess, a shallow recession next year, 2024, it's not looking right now on current trends to be a deep, horrific, high unemployment style recession, which is the thing that would take that nominal property crash into significant figures. So there we go. That's my hypotheses on where we are right now following that report. I would love to see what comments we've got in the comment section. So I'm just going to bring the laptop up and see what people are saying. Catherine, oh my God, I literally get this tune stuck in my head all the time. Where's it at, baby? Hey, you're one of my... Oh, thank you very much. Where's it at? I much appreciate it. Massive action. Bigger the crash, the bigger the discounts will be. So interesting, massive action. So let's talk about property investment specifically right now, because I know a lot of people are sitting on the sidelines. And I think, look, some people are talking about selling their own houses or have sold their own houses. When I say some people, I talk about some other YouTube narratives out there, waiting for a big crash to go back in. That's cool, and I get that. By the way, I did the same for a different reason. I didn't do it to buy back in a lower price. It just worked out conveniently that we're in rental right now with money being invested into other properties. But in terms of property investment, we look at two things for property investment. Number one is generating momentum through value add, and the second is generating massive cash flow. So cash flow in terms of return on your capital left in after you've added value and recycled. So therefore, nominal prices on a UK trend are less relevant to doing that. Of course, you don't want to buy something and it goes down, in value 30% over the next year or so. But there are some amazing opportunities out there now. I would say mainly, specifically in the commercial sector and the retiring baby boomer residential landlord sector, where you are able to buy stuff on very depressed commercial valuations, or with baby boomers who are retiring, and because they've got significant amounts of equity, they can afford to take a big haircut on what was the peak amount of equity last year, because in real terms, it doesn't actually matter that much to them. They can still release as much as they need and retire for the rest of their lives. So that's where the opportunity is. And actually the value arbitrage of purchasing property on commercial basis, sort of empty commercial, mixed use buildings, very depressed right now due to how yield valuation works, and then arbitraging that into residential, is an extremely attractive strategy that we're doing right now, and then generating cash flow through either high density units or short term lets. So we're not sitting on the fence. We are actively deploying funds into UK property market at the moment because there are opportunities there right now. Where it's at says, where it's at, potential inflation rising again with energy shocks from new gas prices. That's interesting. I haven't picked up on gas prices going up, so thanks for that. Where's it at? With potential sabotage to Finland pipeline affecting supply. I do feel the last month or so, I do think we probably will see some inflation feedback into. I wouldn't be surprised if we ticked up this month. Say that will probably now go down like 1%, right? But because of what we've seen, I would not be surprised if we saw a tick up this month. But I don't, because it's done on a year-on-year rolling. We're about to have some very large monthly increases in inflation from last year drop out to the data set. And I think when you work it out statistically, I think Sunak was quite clever in setting his target of 5%? It's halving inflation by December. When you actually look at those, he's picked that date, December, because the big increases were sort of October, November. So when they fall out, it gives himself a much better chance of hitting that target. So I do think year on year, by the end of this year, we will be coming down, but I think it'll stick into Q1 next year. There we go. What else we got? Oh, lots of people talking about the channel. Thank you, guys. That's it. Right. That's all the chats. So with that in mind, has anybody got any questions they want to ask on that data set, or any comments they have on UK property market, UK economy? I know next week we have, I think it's Wednesday, so it's 1 week today, we have the next inflation print. So clearly next Wednesday I'll be going live next Wednesday afternoon or evening to talk through all the data that we've got there. And then I believe actually the next interest rate announcement is not till the first week of November. So they're not that correlated, not the same. Last month they were pretty much the same day. I think it's 1 day in between them. I think there's a couple of weeks in between them this time. Just going to give them plenty of time to look at the next rise. I would not be surprised, right, if we saw another small rise on, I think it's the 2nd of November in terms of interest base rate. Would not be surprised, but I'm not putting my mortgage on it because every time I say it, they do completely the opposite anyway. So that's my thoughts. Right. Any more comments on that, team? I think we are done. If we're all good, it's been a pleasure as always. We're running up to the end of the weekend, or end of the week. Hope you have a great end of the week, great weekend, and I'll see you live next Wednesday to chat through the October inflation print. I'm sure there'll be some nice little surprises we can talk about there, and I look forward to it. Have a great couple of days.